Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Wex Inc. Annual Report. Wex Inc. offers a diverse range of businesses and services through its three main segments: mobility, corporate payments, and benefits solutions. The mobility segment provides fleet payment solutions, transaction processing, information management services, account activation and retention, authorization and billing inquiries, account maintenance, credit and collection services, merchant services, analytics solutions, and ancillary services. These products are marketed directly and indirectly to businesses and government agencies with fleets of commercial vehicles, as well as through co-branded and private label relationships. The corporate payments segment offers payment solutions, including embedded payments, accounts payable automation, and spend management solutions. It markets its products directly and indirectly to customers in various verticals such as travel, fintech, insurance, consumer bill pay, and media. The benefits solutions segment provides a software-as-a-service (SaaS) platform for consumer-directed healthcare benefits, full-service benefit enrollment solutions, embedded payment solutions, plan administration services, custodial and depository services for health savings accounts, and benefit enrollment and administration services. These products are marketed through third-party administrators, financial institutions, payroll providers, and health plans. Overall, Wex Inc.'s diverse range of businesses and services cater to various industries and customer needs, making it a comprehensive provider in the commerce platform market. The stock price of Wex Inc. has remained relatively stable in the past year, with no significant changes exceeding a 1.07% decline. Several key events contributed to this stability, including the company's better-than-expected fourth quarter and full-year financial results for 2025. Despite issuing optimistic guidance for 2026, the stock barely moved following the earnings release. Wex Inc.'s robust third quarter 2025 financial results also played a significant role in maintaining investor confidence and preventing significant declines. The corporate payments segment demonstrated revenue growth, while the company modestly increased its full-year and fourth quarter guidance. Additionally, insider buying by a director of 1,000 shares of company stock signaled confidence in the company's future prospects. The market initially reacted positively to Wex Inc.'s second quarter 2025 financial results, with shares rising by 1.7% following the announcement. Although total revenue saw a slight year-over-year decrease due to unfavorable fuel prices, the positive reaction helped maintain stability in the stock price. Corporate governance updates, such as the board refreshment plan announced in January 2026, are often perceived as neutral to positive for long-term corporate health. These updates did not trigger significant negative stock movements and contributed to the overall stability of the stock price. The reported activist investor pressure from Impactive Capital had a minimal impact on the stock's trajectory, with Wex Inc.'s shares trading 9.8% higher than a year prior as of February 12, 2026. Overall, these events combined to prevent significant declines in the stock price and maintain its stability over the past year. Wex Inc. maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Wex Inc. trades at a higher price-to-earnings ratio of 19 times and a higher price-to-book ratio of 4.38 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 89% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in a company's financial performance can be attributed to several key factors. In the mobility segment, revenue growth is expected in 2025 compared to 2024, but declined in 2024 compared to 2023. This trend suggests that the segment has experienced fluctuations in revenue over time. In contrast, the benefits segment has shown significant revenue growth in both 2025 and 2024 compared to their respective previous years. The corporate payments segment, however, has seen a decline in revenue in 2025 compared to 2024, but a slight increase in 2024 compared to 2023. The interchange income from closed-loop fuel networks and open-loop networks is a significant driver of revenue growth across all segments. Account servicing revenue, licensing fees, per participant per month fee, and variable consideration also contribute to the company's revenue. Other key drivers include interest income, professional services revenue, upfront payments, and minimum monthly fees. The acquisition of Payzer in 2023 contributed $4.3 million to mobility segment revenue, while the Ascensus acquisition added $14 million to benefits segment revenue in 2023. The factoring receivables acquisition in 2025 may have also contributed to revenue growth. Charge-offs and recoveries have a significant impact on the company's revenue. Decreased charge-offs by $157.7 million in 2025, increased recoveries by $20.2 million, and assessed late fees of $27.6 million all contribute to the overall revenue picture. In conclusion, the primary drivers of revenue growth or decline are influenced by a combination of factors including interchange income, account servicing revenue, licensing fees, variable consideration, interest income, professional services revenue, upfront payments, minimum monthly fees, acquisitions and divestitures, charge-offs and recoveries, and unrealized losses and gains. The company's financial performance has shown a significant improvement in recent years. One key indicator of this success is the generation of positive operating cash flow. This means that the company is able to generate more cash from its core business operations than it spends on expenses such as salaries, rent, and equipment. According to page 65, the company's operating cash flow has been steadily increasing over the past few years, indicating a strong financial foundation. Furthermore, page 68 highlights the company's ability to manage its working capital effectively, which is another key factor in generating positive operating cash flow. Additionally, page 69 shows that the company's revenue growth has outpaced its expenses, contributing to its positive operating cash flow. The generation of positive operating cash flow is a significant achievement for any company, as it indicates that the business is financially sustainable and able to invest in future growth opportunities. As noted on page 136, this positive trend is expected to continue in the coming years, further solidifying the company's financial position. The company's debt level has undergone significant changes over the past year. As of December 31, 2025, the total debt outstanding was $4.9 billion, a substantial increase from previous years. The senior notes increased by $550 million, while term loan principal borrowings and revolving credit facility also saw increases. Furthermore, advances from the FHLB skyrocketed from $3.2 billion in 2024 to $18.4 billion in 2025. In terms of interest expenses, the company has experienced fluctuations due to rising interest rates and changes in debt arrangements. While there were instances where interest expenses increased, such as a $12.7 million rise in short-term debt, other periods saw decreases. For example, financing interest expense net of financial instruments decreased from -$235.9 million in 2024 to -$240.6 million in 2025. Additionally, interest rates on certain types of debt, like securitized and participation debt, have decreased. Overall, the company's debt level has increased significantly, while interest expenses have changed due to various factors, including rising interest rates and changes in debt arrangements. Management's outlook and strategy. The company's management has outlined a clear vision for the future, focusing on investment in growth initiatives. This is evident from significant investments made in technology and business expansion. The strong financial position of the company, with adequate cash to fund needs for the next 12 months, provides a solid foundation for these plans. Management is committed to maintaining financial discipline while navigating various risks such as foreign exchange rate changes and interest rate volatility. They are also aware of credit risk and may initiate strategies to hedge certain foreign currency risks in the future. The company's accounting policies, including revenue recognition and expense associated with service-based stock options, demonstrate a commitment to transparency and accuracy. Overall, management strategy is centered around investing in growth initiatives while maintaining financial discipline and managing various risks. This approach suggests that they are committed to expanding their business and achieving long-term success. The company has made several strategic moves through acquisitions and divestitures in recent times. On the acquisition front, one of the notable deals was the purchase of SBI's remaining interest in Poe Holding, which was completed under a share purchase agreement. This move is expected to bring in new assets and expertise to the company. In addition to this, the company has also acquired certain assets from Bell Bank, with contingent consideration derivative liability being recorded as part of the deal. The total value of these assets is deemed to be $58.6 million, which will likely contribute positively to the company's bottom line. The company has also made a significant move on the divestiture front by selling Wex Bank. This decision is expected to help the company focus on its core operations and reduce its liabilities. Overall, these strategic moves are expected to have a positive impact on the company's financials and operational efficiency in the long run. The company's financial activities have been marked by a commitment to returning value to its shareholders. One key aspect of this is the payment of dividends, which has been confirmed on page 36 of the report. This indicates that the company has distributed a portion of its profits to its investors in the form of dividend payments. In addition to paying dividends, the company has also engaged in share buybacks. As noted on pages 48, 70, and 102, the company has purchased back shares from the market, effectively reducing the number of outstanding shares and increasing the value of each remaining share for its investors. This strategy is often used by companies to boost their stock price and reward shareholders. That concludes the financial summary for Wex Inc. Feel free to comment below, and I will be happy to answer them when possible.